No, no, no. Do not even feed your dog in this dish. Keep it out of your investment portfolio. And yes, we're talking about the stock DISH. That stock symbol is DISH. And now if you want to see an archive of the above average stocks, then just go to our site and sign up for the free 2-week subscription at buffettandbeyond.com. All one word. Buffett is spelled with 2 F's and 2 T's. And then you're going to see the good stocks here, folks. And remember, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. Now, let's go over DISH. The blue lines represent the average stocks. The green lines are the stock DISH. Now, let's talk about DISH for a second. One of the large Wall Street research departments was touting DISH just the other day. Now, this is a leading provider of direct broadcast, satellite, and streaming pay TV services. Their big competitor back in the day was a company called DirecTV, which we absolutely had in our growth portfolio. Now, DirecTV did really well for us, and because we followed DirecTV, we also followed DISH. And folks, there was never a comparison between DirecTV and DISH. DirecTV had it all over DISH. Now, what happened to our position in DirecTV? Well, it was bought out by AT&T back in 2015, and we cried over that because DirecTV was doing so well for us and DISH was doing nothing. So then all of a sudden the other day, here comes a rating about DISH and says, buy this stock. Now they're talking about investments. And folks, maybe I could see it as a trade, and I really can't, but maybe it's a trade. But folks, it is not an investment. So look at the average, which are the blue lines. The average stock has a clean surplus return on equity. Now, return on equity, think of your bank account. You want to go into the average stock bank account? 13.5% is what they are making. What is DISH making? 5.2%. In other words, 1/3 of the average stock. What about net income? Net income is the same as earnings minus a few things in a clean surplus condition. In other words, net income is a comparable earnings number. So the average stock earning 13%. Notice the correlation between the earnings and the return on equity. Very, very close in there. Okay, but what about DISH? We're talking about DISH. -9% over the past 5 years. What kind of stock is that, folks? And revenue, the average stock is bringing in revenue, an increase in revenue of 7.1% per year. DISH, half of that. So why would you even think about DISH? Now, let's look at how this stock has done in the past 1 year. Black line is the S&P 500. Now remember, 96% of professional money managers who manage the publicly traded mutual funds cannot outperform this black line, which is the S&P 500. So if you have a portfolio of stocks that are underperforming the S&P 500, you're going to underperform the S&P 500. You might as well go out and buy the S&P 500 in the form of a mutual fund or an ETF. Very low expenses. So over the past 1 year, the S&P is up about 16%. DISH is this yellow-colored line, down 60%. Folks, this is just 1 year. That is about almost an 80% difference. Now, let's go over the past 5 years. Black line again, S&P 500, up about 60% over the past 5 years. And this is what you would expect the S&P to do, about 9, almost 10% per year, a little over 10% per year. What did DISH do? Down 80%. So maybe the company that's touting DISH is saying, hey, it's good for a trade. How much lower can it go? Well, it can go even lower than 80%, a negative 80%, folks. So you got to be really, really careful in here. We're talking about investment portfolios, not trading portfolios. Let's look at the numbers. I want you to look at the net income over here, which is the clean surplus earnings, and you can see that it is going down. So you have a company that's still making money, but it is making money at a declining or decelerating rate. Who in the world wants that? Okay, nobody. Now, when you turn that into the ROE, think of the bank ROE. Bank S&P 500 paying you 13.5%. DISH for next year, 2024, expected 2.4%. That is terrible. Net income growth, 5-year average, a negative 9.9%. Who in the world wants that? What rating company, what research company is going to say buy this stock unless they're talking about trading? And guess what? In their article, they didn't talk about trading. They talked about investing. Wrong, wrong, wrong. Revenue growth, the average stock 7.1%. Revenue growth in Dish for 2024, almost zero. And the average over 5 years, 4.3%. Want to bring out one point here. Years to pay debt. This is Buffett's rule of thumb. He says if a company takes all the money it's making and uses it to pay off debt, how long or how many years would it take to pay off that debt? His rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. This company would take 40 years to pay off its debt. Folks, I don't know how many of us watching this are going to be around in 40 years. So why would you ever buy a company with this much debt? So, folks, here's the return of the stocks. If you sign up for that 2-week free subscription, you're going to see a lot of these stocks are portfolio simple year after year on average since 2002. So we're looking at 21, 22 years here, folks. Portfolio returning. Our growth portfolio, remember, our growth portfolio is buy and hold with very few changes, if any. On the last day of the year, we might substitute some stocks that haven't done well with stocks that are going to do well. Portfolio of 30 stocks. We've been returning 16% on average since December of 2002. S&P 500 up 9.7%. Compounded, in other words, if you left money in at the end of 2002, you would have a 1,061% increase in your portfolio value versus the S&P 500 of 377%. Folks, 377% over 21, 22 years is not bad. However, I would rather have more, like 3 times as much. I would rather have more than less. And this is our growth portfolio. So, folks, go get our free 2-week subscription. Go to our site, buffettandbeyond.com. You'll see an archive. You'll get a password in order to get into our subscribers locker. All you have to do is click, fill in your name, your email address, and folks, that's all we need. You're going to get free 2 weeks and have access to our computer program. You're going to have access to the archive of really good stocks. Okay, folks, remember, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett.